Right now, somewhere in Australia, thousands of retirees over 50 are paying tens of thousands of dollars in taxes they legally don't have to pay. Not because they made a mistake, not because they broke any rules, simply because nobody ever told them that these 3 tax-free retirement strategies exist. And the scary part? If you're over 50 and planning for retirement, you could be one of them. Stay with me, because what I'm about to show you could change the way you think about retirement forever. Welcome back. If this is your first time here, my name doesn't matter as much as what you're about to learn in the next few minutes, because today we're talking about something that affects almost every Australian over 50, yet almost nobody talks about it openly. We're talking about the silent tax leak that's draining retirement savings across this country, one quarterly statement at a time. And the strategies I'm about to share with you aren't loopholes. They aren't grey areas. They are completely legal, fully sanctioned by the Australian Taxation Office, and yet most financial advisors rarely tell you about them in enough detail for you to actually use them properly. Before we go any further, let's be clear about something. This video is for educational purposes. I am not a licensed financial advisor, and nothing here should be taken as personal financial advice. Your situation is unique, and before making any decisions, you should speak with a qualified financial advisor or tax professional who can look at your full circumstances. But what I can do is show you what exists, so that when you do sit down with a professional, you're asking the right questions instead of walking in blind. So let's talk about the hidden problem first, because once you understand the problem, the solutions will make a lot more sense. Here's something most Australians don't know. The retirement system in this country was not designed to be simple. It was designed to reward people who understand it, and quietly cost money to people who don't. Every single year, retirees who are completely unaware of certain rules end up paying more tax than they legally need to, simply because they treated their superannuation and their retirement income the same way they treated their regular paycheck during their working years. But retirement income doesn't work the same way. The rules change, the thresholds change, and if you don't adjust your strategy, you could be handing the tax office money that should have stayed in your pocket or in your children's inheritance. Think about it this way. Imagine working for 40 years, raising a family, paying off a mortgage, building up your superannuation balance bit by bit, sacrifice by sacrifice. And then, in the final stretch, the most important stretch, you lose tens of thousands of dollars simply because nobody explained how the system actually works. That's not just a financial loss, that's years of your life, gone, for nothing. The scary part is, this isn't a rare situation. This is happening right now, today, to people just like you. People who worked hard, saved diligently, and assumed that once they retired, the hard part was over. But the truth is, retirement is when the financial decisions matter more than ever, because you no longer have years of future income to make up for mistakes. Every dollar lost in retirement is a dollar that's gone for good. So let's fix that starting right now with strategy number 1. Strategy number 1 is what I call the transition phase advantage, and it revolves around something many Australians have heard of, but very few actually understand or use correctly, which is the transition to retirement approach available through superannuation once you reach your preservation age. Here's the part that surprises people. You do not need to fully retire to start accessing certain tax advantages tied to your superannuation. If you are still working, even part-time, there is a window where you can begin drawing an income stream from your super while simultaneously reducing the tax on your take-home pay, all within the legal framework set up by the government specifically for this purpose. Most Australians don't know that this window exists, let alone how to use it properly. They think it's all or nothing. Either you're working and paying full tax, or you're retired and living off your super. But the system actually allows a middle path, one where you can potentially reduce your taxable income while topping up your superannuation through salary sacrifice, creating a kind of financial pivot that can result in meaningfully less tax paid over the years leading into full retirement. The exact savings depend entirely on your income, your age, and your super balance, which is exactly why this strategy gets ignored. It's not flashy, it's not simple, and it requires someone to actually sit down and run the numbers for your specific situation. But for the people who do it properly, the difference over several years can be significant. Now here's where it gets even more interesting, and this leads us into strategy number 2, because once you actually retire and start drawing your superannuation as an income stream, the tax treatment changes again, and this is where the real opportunity lives. Strategy number 2 is built around what happens once you turn 60 and begin drawing what's known as an account-based pension from your superannuation. Here's the part that shocks people when they finally learn it. For most Australians, once you reach the age of 60 and begin receiving an income stream from a taxed superannuation fund, that income can be completely tax-free. Not reduced, not discounted, tax-free. The earnings generated inside that pension account can also receive favourable tax treatment compared to having the same money sitting outside of superannuation in your personal name. Let that sink in for a moment. Money inside the right structure, drawn the right way, after the right age, can come to you without the same tax burden that would apply if that same income came from a regular savings account, an investment property, or a term deposit held outside super. This is one of the most powerful and most underused advantages in the entire Australian retirement system, and what financial advisors rarely tell you in plain language is just how dramatically different the outcome can be depending on where your money sits. The same dollar sitting in two different accounts, taxed in two completely different ways. Here's a real-life scenario to paint the picture. Imagine two retirees, both 65 years old, both with similar total savings. One has the bulk of their retirement savings inside a properly structured superannuation pension account. The other has a large portion sitting in personal investments outside of super, perhaps in shares or term deposits built up over the years. Both might have very similar account balances on paper, but the tax outcomes on the income generated from those balances could be worlds apart. One retiree could potentially be paying little to no tax on the income drawn from their pension, while the other could be losing a meaningful chunk of their investment earnings to tax every single year, simply because of where the money is sitting, not how much money there is. This could cost you thousands of dollars every single year if your retirement savings are not structured in the most tax-effective way available to you. And because this isn't something that gets fixed automatically, it has to be a deliberate decision, often made well before retirement actually begins. Now let's move to strategy number 3, and this one tends to surprise people the most, because it involves something most people associate with selling the family home, not with tax savings. Strategy number 3 involves what's known as downsizer contributions. Here's how it works in simple terms. If you're over the age of 55 and you sell a home you've owned for a long period of time, there is a provision that allows you to contribute a significant lump sum from the sale proceeds directly into superannuation, outside of the usual contribution caps that normally limit how much you can add to your super each year. This means that retirees sitting on a large amount of equity in their home, equity that would otherwise just sit there or eventually pass through an estate, can potentially move a substantial sum into a tax-advantaged superannuation environment, setting up a more tax-effective income stream for the years ahead. The scary part here is that so many retirees sell their home, perhaps to downsize, move closer to family, or reduce the burden of maintaining a large property, and they simply deposit the proceeds into a regular bank account, where the interest earned then gets taxed at their full marginal rate every single year. Meanwhile, the same money, moved into the right superannuation structure, could potentially generate income with little to no tax applied, depending on how it's set up. Most Australians don't know this option exists, and even fewer realise there are specific conditions and timeframes that apply, which means missing the window can mean missing the opportunity altogether. Let's bring this to life with a real scenario. Picture a retired couple in their late 60s. They've lived in the same family home for over 30 years. The kids have moved out, the house is too big, the upkeep is becoming a burden, and they decide to sell and move into a smaller, more manageable property. The sale nets them a substantial amount above what they need for their new home. Now, they have a choice. They can let that surplus sit in a savings account, slowly losing value to inflation while generating taxable interest income every year. Or they can explore moving a portion of those proceeds into superannuation under the downsizer provisions, potentially setting themselves up with a far more tax-effective income stream for the next 20 or 30 years of retirement. The difference between those two choices, compounded over decades, is not small. It can be the difference between a comfortable retirement and a stressful one. So now you've seen all three strategies: the transition phase advantage, the tax treatment of account-based pensions after age 60, and the downsizer contribution opportunity. But here's the question you should be asking right now. Why doesn't everyone know about these? And the honest answer is uncomfortable. The Australian retirement system is complex by design, and the people who benefit most from that complexity are not always the retirees themselves. Many financial institutions profit more from keeping you in default settings than from helping you optimize your structure. That doesn't mean every advisor is acting against your interests, far from it, but it does mean that you cannot afford to be passive about this. You have to be the one asking the questions. So what should you actually do with this information? Let's talk action steps, because knowledge without action doesn't put a single extra dollar in your pocket. First, get a clear picture of where your money currently sits. How much is inside superannuation and how much is outside it in your personal name? This single step reveals more about your tax exposure than almost anything else. Second, if you are still working and over your preservation age, look into whether a transition to retirement approach makes sense for your specific income level and super balance. This is not a one-size-fits-all decision, but for many people in the right circumstances, it can meaningfully reduce tax paid in those final working years. Third, if you're approaching or already past age 60 and haven't reviewed how your superannuation pension is structured, this needs to become a priority conversation with a licensed financial advisor. The difference between an optimally structured pension and a poorly structured one can be the difference of thousands of dollars every single year, year after year, for the rest of your retirement. Fourth, if you're considering selling your family home or you've recently sold it, look into the downsizer contribution rules and the specific timeframes that apply, because this window does not stay open forever, and once it closes, the opportunity is gone. And here's something I want you to do right now while you're watching this. If this video has opened your eyes to even one strategy you didn't know about, hit the like button and subscribe to this channel, because we publish content like this regularly, specifically for Australians over 50 who are serious about protecting what they've worked their entire lives to build. And drop a comment below telling me which of these 3 strategies surprised you the most, because I read every single comment and it helps me know what to cover next. Let's quickly summarize what we've covered today, because repetition is how this information actually sticks. Strategy number 1 was the transition phase advantage, using the period before full retirement to potentially reduce tax while building super. Strategy number 2 was understanding how account-based pensions are taxed after age 60, and why the same dollar can be taxed completely differently depending on where it sits. Strategy number 3 was the downsizer contribution opportunity, turning home equity into a more tax-effective retirement income stream. Here's the truth nobody wants to say out loud. The Australian retirement system rewards informed action and quietly penalises inaction. Every year that goes by without reviewing your structure is a year where you might be leaving money on the table. Money that could have funded more time with grandchildren, more travel, more security, more peace of mind in the years that matter most. This isn't about being greedy. This is about keeping what is legally, rightfully yours, instead of handing it over simply because nobody explained the rules clearly enough. I think about the retirees who never get this information, who spend their final working years and their early retirement years overpaying tax, not out of carelessness, but out of trust. Trust that the system would naturally guide them to the best outcome. And that trust, more often than not, is misplaced. The system doesn't guide you, it waits for you to ask the right questions, and if you never ask, it never tells you what you're missing. So here is my final message to you today. You worked decades for this. You sacrificed, you saved, you planned. Don't let the next 20 or 30 years of your life be quietly diminished by a tax structure you were never taught to understand. The strategies exist, the rules are public. The only thing missing for most people is awareness, and today, that awareness gap just got a little smaller for you. If you found value in this video, please subscribe, hit the notification bell so you don't miss the next breakdown, and share this with someone in your life who is over 50 and approaching retirement, because this information could genuinely change their financial future. And if you want help applying any of this to your specific situation, speak with a licensed financial advisor who specializes in retirement planning. Because general information is the starting point, but personalized advice is what turns information into real results. Thank you for watching all the way to the end. That tells me you're serious about protecting your retirement, and that's exactly the kind of person this channel is built for. I'll see you in the next video, where we'll go even deeper into the strategies that most Australians never get the chance to learn about until it's too late.